Hello, welcome to this educational series on portfolio management. If you find this video beneficial to you as a student, learner or investor, please click the subscribe, like and share so that others would have the opportunity to learn too. The objective of this video production is to support university learning in specific and investor education in general as we move through the critical stage of COVID pandemic. As you know, we are currently living under a totally different world with new normal, new way of communicating and socializing. The material in this video is meant to promote the learning of scientific investment knowledge, both at university level as well as general public level. The knowledge could be highly beneficial to ordinary investors on the street too. During the COVID pandemic period, many scholarly journals and research publishers have made their content open access to support the society in general, and I'm happy to join them too. I'm truly blessed to have the opportunity to share. This topic is about momentum and contrarian strategy. It is hoped that at the end of this video, you can understand and apply these strategies in investment. Let's learn together. Contrarian investment strategy is a strategy that attempts to buy securities when the majority of other investors are bearish. In contrast, the best time to sell a stock is when the majority of other investors are the most bullish about it. The contrarian investor will attempt to always purchase the stock when it is near its lowest price and sell it when it's near its peak. Value investors adopt a contrarian investment philosophy based on the premise that investors can profit by betting against the overly emotional crowd. To be successful, contrarian investors argue that one must buy the fear and sell the greed. Implicit in this approach is the belief that stock returns are mean reverting. This means stocks are priced to produce returns consistent with their risk-adjusted expected return, or mean. Now, let me introduce a totally opposite investment strategy, the momentum strategy. A price momentum strategy assumes that stocks that have been hot will stay hot, while cold stocks will also remain so. Investors who use momentum strategy believe that good or bad recent performance of a particular stock continues over time. There is a tendency for firms with positive past return to produce positive future returns. This table compares the differences between contrarian and momentum strategy. As you can see, both strategies are opposite of one another. Momentum strategy is suitable for short horizon returns. Contrarian strategy is suitable over long horizon returns. Momentum strategy assumes continuation in price direction, while contrarian strategy assumes mean reversion. According to momentum strategy, what went up over the recent past tends to keep rising. The winners keep on winning, so buy them today. On the other hand, what went down over the recent past tends to keep falling. The losers keep on losing, so sell them short today. Contrarian strategy believes in the opposite. So, which strategy shall we use? According to efficient market hypothesis, past price changes do not predict future price changes. Both contrarian and momentum strategies work when the market is inefficient. Contrarian strategy works when the market overreacts. On the other hand, momentum strategy works when the market underreacts. Which strategy shall we use? We are going to look into the literature and empirical findings. The two pioneering and highly cited journals in this area are Bondt and Thaler 1985, Jagadeesh and Lakonishok 1999. Over time, different sample periods and stocks may produce different results. I would strongly encourage students to look into recent years' journal publication. The process will broaden your knowledge. Let's look into Bondt and Thaler's journal. The photo shows my collection. I strongly encourage students to read the original article too, to build up your academic strength during your university life. The objective of the Bondt and Thaler study is to test if the overreaction hypothesis is predictive. The research was conducted using monthly return data of New York Stock Exchange common stocks. The sample period spanned over a long horizon from 1926 to 1982. In this graph, stocks with the worst market performance over the prior 3 years are called loser portfolio. Stocks with the best performance are labeled as winners. Portfolio of prior losers are found to outperform prior winners. According to Bondt and Thaler, 36 months after the portfolio formation, the losing stocks have earned about 25% more than the winners. What can we learn from the findings of Bondt and Thaler? Bondt and Thaler show that investing on an overreaction hypothesis could provide consistently superior returns. The findings is consistent with the overreaction hypothesis. This means most people overreact to unexpected and dramatic news events. The overreaction effect is asymmetric. It is much larger for losers than for winners. In general, Bondt and Thaler's studies support the contrarian strategy. Next, we shall look into a research study on momentum strategy by Chan, Jagadeesh, and Lakonishok in 1999. The photo shows my collection too. Again, I strongly encourage students to read the original article. The objective of Chan, Jagadeesh, and Lakonishok's study is to evaluate the profitability of price momentum strategies based on two areas, past return and earning momentum. The sample period is from 1973 to 1999. The sample data consists of all the stocks listed on the New York Stock Exchange, American Exchange, and Nasdaq. This study divides all the stocks traded in the U.S. market over a 5-year period into 10 different portfolios based on their past 6-month price movements. Returns are calculated over the following years. The result shows that strategies based on past return and earning momentum yield significant profits over a 6 to 12-month horizon. The data appear to justify the price momentum strategy. The portfolios with the highest level of price momentum generated the highest subsequent returns. What are the implications of Chan, Jagadeesh, and Lakonishok's study on investment strategy? Well, significant profits are possible from a simple price momentum strategy of buying past 6-month winners and selling past 6-month losers. However, we need to note that chasing momentum can generate high turnover. So much of the potential profit from the momentum strategies may be dissipated by transaction costs. Therefore, implementation of momentum strategies requires a focus on managing trading costs. How far have you understand the differences between contrarian and momentum strategy? Here I have designed a quick test for you to test your understanding. Identify which of the following statements refer to contrarian strategy or momentum strategy. You may pause the video and try before looking at the answer. The answers are highlighted in red. I hope you have a good try. I hope you have learned something from this video. See you and goodbye.